Okay, Professor Karn here with you today, and in this video we're going to take a look at receivables as well as bad debt expense in an overview, and then in some other videos we can take a look at some problems on these topics. So what type of receivables do we have? We've already seen some of these before. We know that we have accounts receivable, money that's owed to us by our customers for either a good or service that we've provided. Notes receivable, typically where we lend people money or give them some type of item or good or service, and we're going to not only be owed the principal amount, but we're also going to earn interest revenue on that. And then you may have some other receivables, things like dividend receivable if you're owed dividends, or if you have interest receivable, you'd be owed interest. So the question that we have to ask ourselves is, will we collect all of our receivables? And the answer to that is no, because we already know that not everyone will pay their bill. So we really have to look at the different types of credit policies that we need to develop when we think how we're going to collect our receivables. So really we should be focusing on strict credit policies. I would say that you probably typically don't want to have your credit policies give people more than 60 days at the absolute most to pay their bill. You'd probably want to limit it to your your newest customers to a 30-day pay cycle. And then if you have trusted people that you have relationships with, you certainly could have a 60-day thing. So I would say that you want to try to keep your average days uncollected to 45 or less, so that people are paying their bill and paying it within a timely fashion. And remember, you could always offer a discount like we saw for the previous material to entice people to pay within a short period of time. Then we talk about bad debt expense, and it's really something that we have to estimate at the end of the accounting period, and realizing that in some cases that people aren't going to pay their bill, and we need to use some new accounts for this process. So if you've used the note cards to help learn your accounts, if you've gone through the course, you might want to add these couple new accounts to your note cards. We have two different methods that we can focus on how to do this. Basically, you have the direct write-off method. That is not in compliance with generally accepted accounting principles because it violates the matching principles, so we're really not going to use that in this course. The method we're going to look at is the allowance method, and you have within that method three different ways to estimate bad debt expense, and they are the percent of sales method, the percent of receivables, and the aging analysis of accounts receivable. So here are our new accounts that you want to record. Obviously, bad debt expense would be a traditional expense account with a debit balance. And we have a new contra asset account called allowance for bad debt, and that would have a credit balance. So we will need these two accounts to help us estimate bad debt expense. And then should we have to determine that we are actually going to write off someone's account as not being collectible, we will use the allowance for bad debt as a tool to help us with that. So here's our basic journal entry format to record bad debt expense. You're always going to debit bad debt expense and credit your allowance for bad debt. Now here's the thing that we have to really pay attention to. Your amount of your adjusting entry will depend on what method you are using to estimate it. And if you're using percent of sales, percent of receivables, and aging analysis, the amount of our adjusting entry will be different as far as how we calculate that. So we really need to be attentive to detail in this case. Now, in the past, we've just listed accounts receivable on the balance sheet as a number. Well, that really didn't reflect the true amount of accounts receivable we think we're going to collect. So what we have to do on the balance sheet going forward is to calculate accounts receivable net in the current assets section of the balance sheet. And the way we do that is we take accounts receivable and we subtract out our allowance for bad debt, which is our contra asset account, and that yields to us accounts receivable net. Remember, this entire calculation should be shown on the balance sheet just like we similarly did with depreciation when we took an asset, subtracted the accumulated depreciation to get the asset's book value. So we'll do the exact same process here to get AR net. Now, how do you write off an account receivable? Well, in this case, what you're going to have to do is use our contra asset account. Because think about it, while we're writing off someone's account, we're not getting any cash for that, but their account receivable balance is going to be reduced to zero. So here's what you do. You debit the allowance for bad debt for the amount that you're writing off, and you credit accounts receivable to reduce that particular account to zero. Again, accounts receivable is decreasing. No cash is coming into the business because we are writing the account off. The other receivable that we'll look at in this chapter in a little bit more detail is notes receivable. And that is we have, when we give either some type of good or service or even cash, and we know that we're going to get paid back not only the principal amount but the interest, earned interest revenue as well. So here's a little bit of some terminology. A promissory note is a written promise to pay. The debtor or the maker of the note signs and promises to pay back the note. The creditor or the payee of the note is the one that's loaning the money or providing the good or service. The principal is the amount loaned. Your interest or your rate is your percentage. Your interest period or time is your note term. And maturity date is when the note is due. And at maturity date, the maturity value, or principal plus interest, is the total amount to be paid to the creditor by the debtor. So we use simple interest. The formula for that is I equals PRT, or interest equals principal times rate times time. And in this case, you want to make sure for our course purposes that you use 360-day years. Do not use 365. And there are various journal entries that are necessary, things like when you've got to record the note, you've got to potentially record an adjusting entry if you've earned interest on the note but it has not yet been paid, meaning you are owed the interest. And then obviously recording the note and interest revenue being paid on the maturity date. Now the thing that you have to remember too is that someone could fail to pay back a note, and in this case what you want to realize is that's referred to as dishonoring a note, and the maturity value is still owed. So the principal plus interest is now an account receivable. The thing that you have to remember is that once the note matures, it cannot continue earning interest. It would have to revert if it's dishonored and be put into accounts receivable at that point. Okay, so we're going to take a look at some problems on these topics and go into further detail to see how they're solved.